You can scroll California listings today and everything still looks impressive. Prices remain high, photos are polished, neighborhoods carry the same prestige they always have. There are no boarded windows, no foreclosure waves, no visuals that scream trouble. And that's exactly why this moment matters. Because beneath that surface confidence, something fundamental is shifting, and California is once again leading it. This isn't a sudden crash and it isn't panic. It's a slow separation between perception and reality. California is a belief-driven market. People don't just buy homes here for shelter. They buy narratives, status, opportunity, lifestyle, permanence. When belief is strong, numbers stretch. When belief weakens, numbers correct fast. That's why prices here don't roll over gently. They hold until they don't. If you've been watching California closely, you've probably felt this tension already. Homes sit longer than they used to. Price cuts appear, quietly, often framed as strategic. Buyers tour without urgency. Sellers wait for demand that feels like it should return, but doesn't behave the same way. Nothing looks broken, yet momentum has clearly slowed. That contradiction confuses people, because we're trained to look for obvious damage. We expect housing downturns to announce themselves with chaos. But California doesn't break that way. It breaks psychologically first. The story cracks before the spreadsheet does. Buyers stop assuming tomorrow will bail out today's decision. Sellers stop feeling protected by reputation alone. Why California first, again? Because extremes reveal truth sooner. High prices amplify small shifts in behavior. Investor concentration accelerates exits. Tech-driven income volatility feeds directly into demand. When confidence softens here, it shows up faster than in markets where affordability still absorbs mistakes. This isn't about hating California or predicting doom. It's about recognizing the early signals that only appear in belief-heavy markets. By the time headlines turn negative, the opportunity to understand what's happening has already passed. That early awareness matters because California sets tone for the rest of the cycle. What begins here rarely stays isolated. Other markets watch, adjust, and follow with delay. Seeing the shift now isn't about acting fast. It's about understanding leverage before it becomes obvious to everyone else watching quietly from the outside today clearly. If this feels familiar, you're not late. You're early. You're noticing the quiet break between how California looks and how it's starting to behave. Subscribe and hit the bell. California breaks quietly before it breaks publicly. The countdown starts where cracks appear before headlines do. City number 10 is Riverside. Not broken, not distressed, but undeniably slower. Homes that once disappeared in days now linger. Price reductions show up quietly, framed as minor adjustments, yet buyers hesitate longer than sellers expect. Riverside's vulnerability has always been dependence on long commutes and affordability math. When gas, rates, and job flexibility shift even slightly, hesitation replaces urgency. Buyers aren't running away, they're recalculating. At number 9 is Stockton. This market used to move on momentum alone. Investors, first-time buyers, and relocation demand pushed prices faster than fundamentals could follow. Now that investor appetite is thinning, listings sit just long enough to change perception. Sellers remain anchored to peak expectations, but buyers feel less pressure to act. Stockton's weakness isn't demand disappearing. It's demand becoming selective, and selectivity slows everything. City number 8 is San Jose. This one surprises people because nothing looks wrong on the surface. Clean neighborhoods, strong incomes, polished listings. Yet days on market stretch quietly as tech volatility reshapes confidence. Layoffs don't create panic here, they create pause. Buyers still qualify, but they hesitate to commit at peak pricing without guarantees. Sellers sense resistance but struggle to explain it because the city still should be immune. That belief is exactly what's fracturing. At number 7 is Bakersfield. This market expanded rapidly on the promise of affordability and migration. Builders responded aggressively, and supply crept up just as buyer urgency softened. Now, overbuilding meets hesitation. Homes compete with each other instead of with buyers' fear. Sellers hold firm, assuming demand will catch up, but buyers feel no rush. When supply increases even modestly in belief-driven markets, momentum fades fast. What ties these cities together isn't collapse, it's silence. These used to move instantly, now they don't. Showings happen, interest exists, but decisions stretch. That stretching is the signal. Buyers aren't rejecting these cities. They're reassessing them. This is the early fracture phase. The moment where price hasn't fallen dramatically, but time starts doing the damage. Every extra week on market changes how buyers talk, think, and negotiate. Sellers feel this as confusion. Buyers feel it as permission. Notice the pattern forming: commute dependence, investor sensitivity, tech exposure, overbuilding. Different vulnerabilities, same outcome. Waiting replaces bidding. Not because buyers are scared, but because the penalty for waiting is gone. This is how acceleration begins. Not with crashes, but with hesitation spreading city by city. Once buyers learn patience works in one market, they apply it everywhere. That's why this phase doesn't stay contained. It expands. These aren't the worst hit cities yet. They're the first to bend, and bending always comes before breaking, even when everything still looks fine on the surface today. Stay with us. This accelerates faster than people expect. City. Number 6 is Sacramento, and this is where the shift becomes visible instead of theoretical. Price cuts don't appear alone anymore, they cluster. Multiple listings on the same street adjust within weeks, not months. Failed listings quietly return to market with softer language and lower expectations. The homes still look fine, but liquidity is thinning. Buyers qualify, tour, and hesitate because comparable options now exist. When choice appears, urgency evaporates. At number 5 is San Diego. This one hurts because belief ran deep here. Coastal demand, lifestyle premiums, endless desirability. Yet appraisal gaps are appearing where they rarely did before. Buyers agree on price emotionally, then appraisals interrupt the story. Deals stall or collapse without drama. Sellers blame rates. Buyers blame math. The result is the same. Transactions slow, inventory builds, and price adjustments follow in waves instead of whispers. Investor behavior exposes this phase clearly. In San Diego, short-term rental optimism and appreciation narratives once absorbed excess supply. That absorption is fading. Investors aren't panicking, they're stepping back. When yield assumptions weaken, capital pauses. And when capital pauses, prices lose their invisible support. The city still looks premium, but liquidity doesn't care about branding. City number 4 is Oakland. This is where denial truly stops working. Price declines are no longer isolated. They're visible across neighborhoods, regardless of renovation or staging. Listings fail, relist, and return with sharper reductions. Buyers aren't negotiating aggressively. They're disengaging entirely when numbers don't align. That silence is louder than rejection. Oakland's vulnerability has always been investor sensitivity and policy friction. As returns compress, investors exit quietly. Owner-occupants feel the shift next. Appraisal gaps widen. Financing contingencies stretch. Deals fall apart later in the process, after inspections and verification, not at the offer. That's how you know the market has changed structurally. What connects these cities is not ugliness. The homes still photograph beautifully. Streets remain desirable. The damage isn't aesthetic, it's transactional. Liquidity is the first thing to break in belief-driven markets. When buyers hesitate and capital pauses, price becomes negotiable whether sellers accept it or not. This is the stage where momentum turns against expectations. Sellers still reference peak comps, but buyers reference current reductions. Appraisers reference exposure time. Lenders reference risk. Every participant begins speaking a different language, and deals require alignment that urgency used to bypass. Notice how behavior changes here. Buyers stop escalating. Sellers stop dismissing feedback. Agents stop promising speed. Everyone senses the floor moving beneath assumptions. This isn't panic. It's realization arriving late. These cities aren't crashing loudly. They're compressing quietly. And compression does more damage to confidence than volatility ever does. Once people see multiple price cuts normalize, belief resets permanently. This is where watching matters, because by the time headlines acknowledge decline, liquidity has already been gone for months. The market teaches first through friction, then through numbers. This phase feels uncomfortable because it removes narrative comfort. There is no villain, no single cause, no external shock to blame. Just accumulation. Each failed deal adds weight. Each reduction shifts expectations. Buyers don't announce their withdrawal. They simply stop stretching. Sellers don't surrender suddenly. They adjust incrementally. But markets don't care about intention. They respond to throughput. Liquidity loss changes how long it takes to exit, refinance, or reposition. That's the real consequence here. Not falling prices, but shrinking flexibility. When flexibility narrows, risk increases even if prices hold temporarily. That's why these cities matter. They show how belief fades before value collapses, and how numbers follow behavior with a delay that catches most people off guard. If you're watching closely, this is the warning stage, not the aftermath. Outcomes are still being decided. Those who adapt now preserve options. Those who wait for confirmation inherit constraints later. That difference determines who negotiates from strength and who reacts after leverage has already shifted. Quietly, decisively, permanently. Hit the bell. This is where denial ends. City number 3 is San Jose, and this is where belief finally fractures under its own weight. For years, tech income acted like armor here. High salaries justified high prices, and investors leaned into that story aggressively. But when tech hiring softened and bonuses thinned, the math stopped working quietly. Listings piled up not because homes were flawed, but because buyers no longer felt rushed to absorb premium risk. Heavy investor ownership amplifies this shift. When appreciation slows, investors don't argue with the market, they step aside. That creates sudden oversupply, not from new construction, but from existing owners competing for fewer committed buyers. Sellers start by holding firm, then trimming slightly, then chasing momentum that never returns. Each cut isn't panic, it's disbelief wearing down. What changes fastest here is identity. Owners who saw themselves as insulated suddenly feel exposed. The question shifts from "how much can I get?" to "how clean can I exit?" That psychological flip matters more than any single price drop. Once sellers prioritize certainty over peak value, the direction becomes one way. City number 2 is Los Angeles, and this is where scale turns belief collapse into pressure. LA doesn't move as one market, it moves in waves. When multiple neighborhoods soften simultaneously, denial becomes impossible. Oversupply meets patience here in a way sellers aren't prepared for. Buyers aren't hostile. They're selective and they know time is on their side. Investor-heavy segments feel this first. Short-term rental optimism fades. Carrying costs matter again. When exit windows narrow, listings stack. Sellers reduce, then reduce again, not because they want to, but because holding feels riskier than conceding. Loss aversion flips. The fear isn't selling for less. It's being the last one holding. Tech income fragility plays a role here too. When compensation becomes variable, buyers protect flexibility. They don't stretch for marginal upgrades. They wait. That waiting forces sellers to reveal their tolerance for delay. Some adapt early and move cleanly. Others resist until resistance becomes cost. This is the belief collapse phase. Not loud, not dramatic, just irreversible. Markets like this don't bounce on hope. They stabilize only after expectations reset fully. Psychology leads, price follows. What makes this phase uncomfortable is inevitability. Once sellers start chasing, momentum works against them. Each reduction educates the next buyer. Each failed deal reinforces patience. This isn't a warning anymore, it's a transition underway. If you own in these cities, the most dangerous mistake is assuming this is temporary noise. It isn't. Belief broke first, and belief doesn't repair quickly. Outcomes now favor realism, speed of adjustment, and emotional discipline. Subscribe. This is no longer theoretical. This stage rewards those who confront reality early instead of defending narratives. Waiting for clarity here only narrows options because time is no longer neutral. It compounds pressure. Buyers sense it, agents feel it, lenders price it. The longer belief lingers after it breaks, the steeper the adjustment becomes. That's the lesson these cities teach without shouting. When belief collapses ahead of affordability, markets don't pause, they realign. And those who accept that realignment early retain control, while those who resist discover that patience, once an advantage, has quietly shifted sides forever. Understanding this difference determines whether the coming years feel survivable, strategic, or painfully reactive for most homeowners involved now. The number one city is San Francisco, and it isn't because it's the weakest market. It's because it explains the mechanics of what's happening everywhere else in California, just earlier and more clearly. This is the canary, not the exception. San Francisco ties every pressure point together. Tech slowdown shows up here first, not as unemployment panic, but as income uncertainty. Bonuses shrink. Stock compensation fluctuates. Buyers who once felt invincible start protecting flexibility. When the highest earners hesitate, the entire demand stack shifts quietly. Investor exits amplify that hesitation. This market attracted investors who believed scarcity alone guaranteed appreciation. When appreciation stalled, those investors didn't double down. They listed. Not all at once, but steadily enough to create inventory overhang. The city didn't flood. It accumulated pressure. Inventory overhang changes psychology faster than price ever could. Buyers scroll longer. Listings age. Reductions normalize. A home sitting no longer feels rare. It feels optional. That single change rewires leverage. Buyers don't rush. They compare. They wait for terms, not just numbers. This is where San Francisco becomes predictive. When buyers learn waiting works here, they carry that lesson outward. Silicon Valley feels it next. Coastal cities follow. The behavior spreads faster than data. People don't need charts when experience teaches them patience pays. What's striking is how intact everything still looks. Streets are clean. Homes are beautiful. Branding remains strong. That's why this matters. The damage isn't visual, it's transactional. Liquidity fades before aesthetics do. Deals take longer. Appraisals get tighter. Negotiations deepen. Confidence evaporates quietly. This isn't a collapse story. It's a sequencing story. San Francisco shows what happens when belief-driven pricing meets disciplined buyers. The city doesn't fall apart. It recalibrates, slowly, methodically, without drama. That recalibration is the template. If you're watching closely, you're not shocked by this. You sensed it. You saw listings linger. You noticed buyers disengage calmly. You felt urgency leave conversations. That awareness matters because it means you're reading behavior, not headlines. This city isn't warning you about San Francisco, it's previewing California. When the strongest belief market adapts, others follow. Not instantly, but inevitably. Safe assets feel scarce again, not because prices are low, but because certainty is. Buyers will pay for alignment, not stories. Sellers who understand this adjust early. Everyone else waits for momentum that doesn't return. Subscribe. This city explains what comes next. If you recognize the signal here, you'll recognize it elsewhere sooner. That's the advantage. Not fear, not prediction, but understanding how psychology moves first and how markets follow after belief breaks. Quietly, city by city, long before the numbers force anyone to admit what already changed. Zooming out helps this make sense. California doesn't lead downturns because it's weaker. It leads because it's stretched. When a market is priced on belief instead of buffer, it reacts first when confidence shifts. Start with price to income. California runs the widest gap in the country. That gap works during optimism because buyers assume tomorrow will rescue today. When that assumption weakens, the gap stops being aspirational and starts being restrictive. Small changes in sentiment create outsized effects. Investor sensitivity magnifies that reaction. California attracts capital that expects liquidity, not patience. When returns flatten, investors don't negotiate emotionally. They exit. Not all at once, but fast enough to tilt supply. Markets built on end users move slowly. Markets built on capital reprice quickly. Tech concentration adds another layer. Tech income is powerful, but volatile. Compensation depends on equity, bonuses, and confidence. When those wobble, spending pauses. Buyers don't disappear, they delay. Delay is enough to cool a belief-driven market. Regulatory friction then slows recovery. Permits, taxes, insurance, and compliance raise carrying costs. That makes waiting expensive for sellers and unforgiving for investors. Time becomes pressure instead of protection. The final factor is psychological volatility. California markets move on narrative faster than fundamentals. Stories lift prices quickly, but they also unwind quickly. When the story shifts from scarcity to caution, behavior follows immediately. This is why expensive doesn't mean resilient. High prices aren't armor, they're tension. The higher the tension, the faster the snap when pressure changes. California snaps early, not because it's broken, but because it's sensitive. Understanding this removes fear. You're not watching chaos, you're watching sequence. California shows the turn first, the rest of the country follows later, adjusted for local conditions. That's why these signals matter. They aren't about collapse, they're about timing. Cycles reward people who recognize stretched markets early, not those who wait for confirmation after prices move. Stay subscribed. Cycles reward those who see early. This pattern repeats because belief concentrates risk. When optimism compresses margins, markets lose flexibility. California reaches that point sooner. What looks like leadership is simply exposure. If you can read that exposure calmly, you stop reacting emotionally. You start positioning intentionally, long before headlines validate what behavior already revealed beneath the surface for those paying attention without fear, noise, or urgency, while others wait for permission that never arrives again during late cycle shifts statewide repeatedly. California rarely moves alone, even when it looks like it does. What happens here doesn't stay here, not because other markets are identical, but because belief travels faster than data. California functions as a leading indicator for how confidence behaves under pressure. When prices soften here, it isn't a signal of panic. It's a test, a stress test of assumptions that also exist elsewhere, just less visibly. Tech hubs across the country rely on similar income structures, similar equity expectations, similar confidence loops. When buyers in California pause, buyers in other tech markets watch quietly and adjust expectations before headlines force them to. High-cost metros feel this next. Places where affordability was justified by growth narratives start to reprice those narratives internally. Not outwardly, not dramatically, but through slower decisions, longer negotiations, and rising selectivity. The behavior looks calm. The impact compounds. Investor-heavy markets respond fastest after that. Capital doesn't need reassurance, it needs clarity. When California shows that liquidity can thin without chaos, investors elsewhere recalibrate risk models. They don't flee, they demand margin. That demand changes pricing power even where demand still exists. This is why calling this a crash misses the point. Crashes are loud. This is a belief unwind. Beliefs don't break. Everywhere at once, they cascade. One market teaches another what patience looks like, what waiting costs, what leverage really means when urgency disappears. There's no relief in this explanation, but there is orientation. You're not waiting for disaster, you're watching transmission. The same forces testing California are probing other markets quietly, looking for the same vulnerabilities. That's where community matters. People paying attention early aren't alarmists. They're observers comparing notes. If you're seeing longer listings, softer negotiations, or buyers hesitating without fear in your city, you're not imagining it. You're noticing alignment. This cycle doesn't reward speed, it rewards clarity. And clarity spreads the same way belief once did, slowly, quietly, until enough people recognize the pattern to stop reacting and start preparing for what comes next, before markets elsewhere acknowledge the shift publicly and adjust behavior accordingly. Together nationwide, quietly. Housing crashes rarely announce themselves the way people expect. They don't begin with boarded windows, auction signs, or dramatic headlines. They begin much earlier and much quieter when belief changes before numbers do. Prices don't fall first. Conviction does. What you've seen across these California cities isn't chaos. It's a shift in posture. Buyers stopped assuming tomorrow would always be worse than today. Sellers stopped believing time was automatically on their side. Investors stopped treating appreciation as guaranteed. Those changes don't feel like a crash. They feel like hesitation, patience, and selective silence. But those are the early mechanics of every downturn. This is how housing actually turns. Not through panic, but through friction. Listings linger, negotiations stretch, deals fall apart later instead of sooner. Liquidity thins while surfaces still look fine. By the time price charts catch up, behavior has already rewritten the outcome. If you're noticing this where you live, trust that instinct. Watch days on market. Watch how often listings quietly reduce. Watch how buyers speak, not what headlines say. Share what you're seeing locally, because when many people observe the same patterns independently, clarity forms without fear. That shared awareness is how prepared people stay ahead of cycles instead of reacting to them. The next phase doesn't require a collapse. Time does the work. When belief breaks, time applies pressure evenly, forcing alignment long before panic ever shows up. Sellers feel it first in leverage, then in terms, then eventually in price. That sequence is structural, not emotional. In the next video, we'll break down exactly how time forces price even when everyone insists the market is fine, and why waiting markets are more dangerous than fast ones. That's where most people get blindsided. Stay subscribed. This cycle rewards the prepared.